is chapter 5, and this is about inventory. So we like to dedicate an entire chapter to inventory because it is a very large part of any business. So if you think about it, it's pretty much the backbone of what a company does, except for a service company. But think about it, we have a couple different kinds of the company, and we either have a merchandising company or we have a manufacturing company. So the difference is a manufacturing company will actually manufacture it. Think of a Toyota, they put together cars, or even a jean manufacturer. I mean, you can think of a million examples of companies that make stuff. And then there's people that are merchandising companies, so they buy the stuff that people have made and sell them either to wholesalers or to retailers. So our two main kinds of companies and the two different kinds of inventories they have are based on what kind of business they have. So a manufacturing company, they will have raw materials. So say I'm Toyota, I'll have a crate full of steering wheels, and that's raw materials. They haven't been put on the production line yet, they're just sitting there. All right, then when they actually get into the production line, then they are called work in process, which is exactly how it sounds. It's just that it's not a finished good. It's not that it's sitting in the stock room waiting to be used. It's somewhere in between. And then we have finished goods. So a finished good would be an example of a car being completely ready to sell, and it's sitting out in the lot or the warehouse or wherever they keep them. And those are the finished goods. Now, when a company, a manufacturing company, actually sells their product, then it becomes a cost of goods sold. So that's why I have this cost of goods sold down here. Now, merchandising company, they won't have that kind of inventory. They'll just have inventory, period. So the only thing that I really wanted you to pay attention to is that a manufacturing company has lots of different kinds of quote unquote inventory, whereas merchandising companies, they just have one thing on their balance sheets. Okay, once you get into managerial accounting, we're going to talk lots more about this area of raw materials. So I'm sure you'll be excited to talk about that. Okay, so again, we pay attention to inventory, and we have a whole special chapter devoted to how inventory is treated on the balance sheet, because without inventory, we don't generate profits. So think about it. If I'm a coffee cart, for example, and I don't make any cappuccinos, then I'm not making any money. So the inventory that I have to produce the income is really what we're talking about here. So it's a major part of the ongoing business. All right, and not only that, the inventory that I have has to be valued correctly. And this is where we're going to get into some of the conversation that we're having later on in these slides is what's the value of my inventory? And I must count and value it properly, because if I understate it one year, it goes understated the next year, and so on, and it just really clouds up our financial statements. So we want to make sure that our inventory is valued properly, and therefore our income statements and our balance sheets are also stated properly. I also thought you might enjoy seeing that, for example, Intel, which makes computer chips, they would have the different kinds of inventory sitting on their balance sheet. They'd have a raw materials, they'd have a work in process, a finished goods. Whereas a company like Best Buy, where they don't make anything, they just are merchandisers selling stuff, they just have one account called inventory. So that's just kind of the difference of how those two are presented. Okay, so what's included in the quote unquote inventory balance is if a company, whether it's a wholesaler, retailer, manufacturing company, the price that they pay for their inventory is going to include anything that gets it into a saleable condition. So that includes the freight charges, insurance, storage, import duties. You can see all those things right here. Everything that it takes to get that into a saleable condition, less any discounts or allowances or returns or what have you, equals the total price of that inventory. We don't spend a bunch of time talking about that, but I did want to tell you that the price of the inventory is not always just the inventory itself. It's whatever it takes it to get into a saleable condition. All right, so how do we factor our inventory? And you will have some test kind of questions on this, but if you think about it, it's almost common sense. Well, it is common sense. If you have the beginning inventory, which is your asset, $100, you buy some more inventory. Say there's $50 more. How much inventory do you have now? Well, you got $150 worth of inventory that you can sell. In the end, if you look at your balance sheet and your balance sheet says, well, I only have $25 worth of inventory left, you think, aha, that means that I must have sold the difference, $125, right? You can also look at it and say, okay, I started with 100, added 50 more, I've got 150 possible to sell. My cost of goods sold, which is on my income statement, it's an expense. In other words, my inventory is no longer with me. I have sold it, which is a good thing. Then your ending inventory will wind up to be your beginning plus purchases less cost of goods sold. So let's take a look at, because you may get a little confused here. Okay, so here we go with our example. Here's my beginning inventory plus my purchases, goods available for sale, and then I have my less my ending inventory equals my cost of goods sold. So if I give you any, there's 5 possible things that I could give you. If I give you all but one of them, you're going to be able to figure it out. So check this out. I've got beginning inventory of 200. I add $75 worth of purchases, so now I've got $275 worth of stuff to sell. If I've sold $125 of that, how much do I have left over? I think you can figure that out, right? And with any luck at all, you came up with $150. Okay, let's try another one. If I started with $325, I add $100 to the pile. That means I've got $425 worth of inventory to sell. If I look in my inventory stock and I say, well, I've got $300 left, that must mean that I sold $125. Those are my only options. I'm not talking about like shoplifting, theft, damage, returns. I'm just looking at the straight numbers here, okay? So don't go get carried away for me. All right, so let's try a different way. If I don't know how much I started with, but I know that I added $200 in purchases, and at the end of the day I had $125 of ending inventory, and I wound up with a cost of goods sold of $150, what does that mean? Well, my goods available for sale must have been $250, 100 plus 150, right? That means that I had $250 available for sale. I bought 200 throughout the year, so that means I must have started with 50. Let's check it out. $50 plus 200 would be $250. I sold 150, so I had 100 left over, and that all checks out. See how fun this is? Okay, let's try one more. So I started with $400 in beginning inventory. I don't know how much I purchased, which means I don't know what I had available to sell. But if I had ending inventory of 200, cost of goods $250, that means I must have had $450 worth of stuff to sell. I started with 400, that means I must have had $50 that I purchased. Okay, and the next thing are, I think I have one more here. Let's see. Yeah, weighted average. Okay, so there are 4 basic kinds of ways that I can cost my inventory. Now let's think about this. We know that we don't get all of our inventory in at the very first day of the month, and then we just sell it throughout the period. We acquire things, we sell things, we acquire things. It kind of is a dynamic process throughout the month. So how do we know what to cost our inventory at? Because we also know that when we get inventory in, it's never at the same cost. Think about like gas prices. Oh my goodness. You know, they're always at a different price. So we're getting in inventory at different costs to us. And how do we know which cost to use when we're thinking about putting our cost of goods sold on our inventory? So anyway, it's it's either specific identification, which is the least common. I don't know why I put that first, but there it is. Specific identification means that I know exactly which item has exactly which cost, and I'm going to use that cost when I sell it. The other one is first in, first out. And the another one is last in, first out, and then there's a weighted average. So I'm going to go over these one at a time with you so that we can tell how this all works. Okay, I'm going to use a company called the Racing Bike Company, and here's basically how their month of August looked. On the first, they had an inventory of 10 units at $50. That totals 500. You with me so far? I know you are. So August 10th, they purchased some bikes for they purchased 15 bikes and $100. And now I've got a total cost of $1,500 for that purchase. Then on the 14th, I sold 20 bikes at $300 a pop. On the 15th, I purchased more bikes for $150. August 28th, even more bikes for $200. You see how the cost is going up? I used a very simple example so you could see this. These are all the same bike. This is my dream bike right up here because someday I'm going to do a triathlon with this bike. All right, and then I sold some more bikes. So this is just the overview of all of the activity for August. Now I'm going to walk you through the inventory methods of how to cost this. So here we go. The first one we're going to try is FIFO. FIFO stands for the first in being the first out. So you can see here's my inventory. I had 10 at 50, 15 at 100, then 20 at 150, and so on and so forth. Okay, so what that means is the oldest purchases will be the first costs out. So I actually made you a little spreadsheet, not this. Okay, hold on. There's my lovely spreadsheet. Okay, so I've put this up here so you can see this is the same data, just in a little different format. Now, the first in, first out method says that here's my beginning inventory, then there's my purchases, 15 bikes at $100, then I sold 20. So my first in, first out method says that the first cost in other words, these 10 bikes at $50 are the first costs that are going to go out. Now, just put the brakes on for a minute because this is not the physical flow of the bike. In other words, they're not going to go to the storeroom and look for those exact 10 bikes that they purchased at $50. They're just going to go grab as many bikes as they've just sold and get those. So the cost and the physical flow of the inventory are not the same. All right. So when I sell these 20 bikes, my accountant is going to look at this and they're going to say, well, the oldest cost, the first cost that came in is the $50 a bike. So I'm going to take the 10 bikes at $50, but I sold 20. So now I need to go into this inventory. So I'm going to take 10 of those bikes at $100, and there's my $500 plus my $1,000. There's $1,500 as a cost of goods sold. Now you may want to rewind that and take a look at it, but I'm going to keep moving. So that means that my inventory that I have left after the beginning inventory and the purchases and everything else, less what I just sold, the only bikes I have left are the 5 bikes at $100. Remember, because I took all 10 of those and 10 of those, leaving me 5 left over. All right. Then, fast forward, on the 15th, they purchased 20 more bikes. These were at $150. On the 28th, they purchased 10 more bikes at $200. And then on the last day of the month, they sold 12. So how did they get the cost from those 12? So again, I start at the top. Okay, those were gone. I had 5 more of those bikes at $100, so that's where I'm going to get those. Okay, so the 5 are left, and then I need how many more? 7 more, and I'm going to take 7 from that 20. So I'm going to take, there's the 5 at the 100 plus 7 at the 150, leaving me 13 left over at $150. And then I didn't even touch these 10 at $200, okay? So in other words, the oldest costs are going out first, leaving me with the newest costs left over in my ending inventory. And that's exactly what I'm trying to tell you here. So I just added up my inventory that's on the balance sheet. This plus this is my ending inventory. And my cost of goods sold was the cost of the goods that I sold here. Remember, I sold 20, so that's the cost of those 20 plus the cost of those 12, and that is the total cost of my goods sold. That's the first in, first out method. So I'm taking the first costs that came in and I'm going to move those out first. Okay. Whew. These are the journal entries that I make. So here's my cash from the sale of those bikes. So again, it's either going to be accounts receivable, it's going to be sales, and then that is always the same no matter what inventory and method I use. Here's my cost of goods sold for the first sale. So it's a cost of goods sold, which is an expense account going on the income statement, and it reduces revenue, right, which makes sense. And I take it out of my inventory. There's that 1,500. Okay, the next sale I make is 12. They sold those at $350, so there's my revenue from there. And my cost of goods sold, again, there's my expense account. I reduce my inventory by that 15.5, and that's my first in, first out. Okay, let's go to LIFO. LIFO is actually just the opposite of FIFO. So here I've got the same situation with all of these purchases, but when I look to see which costs I'm going to use the newest costs first, or then to take those bikes out and then go back down to the oldest cost. So let's take a look at my next. Okay, so that just shows you that my oldest costs are going out first. My newest costs are going out first. My older costs are going back to my ending inventory. So let's take a look and see what this looks like on my lovely spreadsheet. Same thing, only now, see, I've got that same beginning inventory, those same purchases. When I sell those 20 bikes, the cost of goods sold is actually going to come from the bottom up. So since I sold 20 bikes, I need to go find those. Now I'm going to use these newest costs first, so you can tell I'm going to take that $15 at $100, the 15 bikes at $100, but I'm not done. I need to go grab 5 of those at $50 as my cost of goods sold, leaving me with 5 left over at $50. Okay, because my last cost in, here's my last cost. My last cost in is my first cost out. So I have that 5 left at $50. That's my ending inventory. Okay, let's fast forward. Then I purchased more, then I sold 12. So again, in the spirit of LIFO, the last one first out, when I sell those 12 bikes, where am I going to go for my cost? Well, here's the latest cost I have is 10 bikes at $200. So that's what that is, 10 bikes at $200. I sold 12, so I need 2 of these. I need 2 of those at $150. So there's 2 at $150. So what do I have left? Well, I have those 5 bikes that I still had from the very beginning, and now I have 18 left of the 150. So I've got 18 of these at 150, and that's my ending inventory. Okay, that one that never got used up here plus whatever I had left. There's my ending inventory. And then my total cost of goods sold was this first sale, that was my cost of goods sold. My second sale, that was my cost of goods sold, and I just added those up. Okay, I invite you to re-look at that again and again. Whoopsie, whoop, hang on. Okay, so the sale is exactly the same. That doesn't change with the inventory method. The only thing that changes is this cost of goods sold inventory number right here that changes. Okay, and again, the second sale was cash. That didn't change at all, but then when I did the cost of goods sold in the inventory, that amount is what shifted because of the way that I took my costs. Okay, that's not me, by the way. All right, then the next one is the weighted average, and the weighted average is kind of like a little bit of both. So again, I've got this one's kind of tricky, so I expect you'll probably look at this video again and again. All right, so here's the same spreadsheet I have. Here's my beginning inventory. I purchased some bikes, then I sold some bikes. So at this point, I need to factor what my average cost is. So I've got 500 plus my 1,500 is 2,000 divided by 25 bikes. See, 10 bikes plus 15 bikes, 25 bikes is $80 a bike. That's the weighted average cost. So when I sell those 20 bikes, I'm going to sell them at an average cost of $80, giving me a cost of goods sold of $1,600. Okay, so it's kind of a in-between thing. Then, how much do I have left? Well, I have basically 5 bikes. I use that same weighted average of $80, and that's my new inventory amount. Okay, so once I do that first weighted average cost, everything goes away except for that average weighted cost amount. Okay, then on the 15th I purchased more bikes, 28th purchased more bikes, then I sold 12. So now I'm going to find a new weighted average. So here was my 5 bikes at $80. That was my 5 bikes at $80. And then I'm going to add the 20 bikes at 150 plus the 10 bikes at 200. Add all that together, comes up to $5,400. I divide that by 35 units. How do I get 35 units? Well, there's 10 bikes. There's 20 more bikes, that's 30 bikes, plus these 5 bikes, that's 35 bikes. And there's my new weighted average. So when I sell those 12 bikes, I take that 12 times the 154, and there's my new, that's my, not my new, but that's my cost of goods sold. And how many do I have left? Well, I've got 23 bikes left at that 154.29, and that gives me the cost right there. That's the amount of my inventory. Okay, so there's my 23 bikes times that 154.29. That's my ending inventory. My cost of goods sold was this amount plus this amount, and that's my total cost of goods sold. Okay, so bottom line here, what do I need to remember? Every time I make a sale, I stop and create a new weighted average cost for my cost of goods sold. Okay, so if it's sold at a specific, the specific identification basically tells you, and I don't know if I did a great job of this, but if I purchase some, this is the same 10 at $50 plus the 15 at $100. If I sell 20 of them, what this is trying to tell you here, I don't know if I did a very good job, but I basically said, well, I know that 9 of those bikes at $50 is exactly what I sold. Plus, I know I sold 11 of those at $100, and that's why I costed it that way. So, specific identification would be really much better at a low turnover kind of a place. Think of like a diamond jeweler or something like that, where they have that one specific ring and they know exactly what they sold that for. Okay? So that's specific identification. And the journal entries are exactly the same. The only difference is what I use for my cost figure here. Okay, and that just kind of shows you the rest of the specific identification, saying I know exactly which ones I sold, and so those are the ones I'm going to use. So you may think, well, isn't specific identification the best one because you know exactly which costs? But it's actually, it would be very expensive for you to keep track of every single inventory item and exactly which cost came in, and so sometimes the cost outweighs the benefit. All right, and then I made you this handy dandy little chart where the ending inventory for FIFO was $39.50. I just copied that from the calculations you and I just made. The cost of goods sold was $3,050. FIFO, there was my ending inventory and cost of goods sold, and weighted average was, did you get this? This is kind of black and white, and gray is sort of in between. All right, you can see that the ending inventory under FIFO is actually valued higher than under LIFO. So if we think about that, the first costs in were the first costs out. So I would expect that the last costs would be the ones that would be left over, right? So the first in, first out, then the cost of the, in a time of rising prices, the cost of goods sold will be lower because my costs were cheaper and then they went up. And when I grab the costs, I grab the cheaper costs, so my cost of goods sold is lower under the FIFO. Under LIFO, it's exactly the opposite. The last costs in a time of rising prices, the last costs in are going to be the most expensive ones, so my costs are actually going to be, the cost of goods sold is going to be higher under LIFO because, again, I'm grabbing those higher costs. And then weighted average will be somewhere in the middle. Okay, so this just describes to you exactly what I said. In a time of rising prices, LIFO will give you a higher cost of goods sold, FIFO lower, and in FIFO will give you a higher inventory. LIFO will give you a lower inventory because I've got those older costs that came in at the very beginning that are still in my inventory. Okay. And that kind of just says exactly the same thing, but maybe in words instead of numbers. So hopefully that helps. This is an overview of your cost of goods sold and your inventory. I made some comments over here just to kind of give you a summary of what we've talked about. Okay, so which one do you use? Well, FIFO matches the physical flow. In other words, think about the milk in the grocery store, the first milk in is usually the first milk out, right? They put the merchandise that needs to be sold first right up front. So that usually matches the physical flow. But as I said in the beginning, the cost and the physical flow are not necessarily the same thing, but the FIFO most closely matches what's actually going on physically. Okay, it's called the balance sheet approach because the oldest costs are out in cost of goods sold. The newest costs, which are closely reflected what the replacement cost is of this, is what's still on the balance sheet. The LIFO is just the opposite. So the last costs in are the first costs out. Those costs are on your cost of goods sold, and therefore your income statement is more properly reflective of the actual cost of merchandise because it was the most recent cost that came in. So we call that the income statement approach. Okay, so it says that if companies use LIFO, for example, for tax reporting, they must also use LIFO for financial. So you can't switch back and forth just based on whatever you decide. Okay, and these are just some more words that I put on here in case you didn't quite get what I said. All right. Okay, and then there's some homework, which we're not going to do. The last part is about the lower of costs and net realizable value. So there is something called lower of cost or market. So what this allows us to do, this is separate and distinct from the actual individual transactions we were talking about when we sell things. At the end of the year, you're looking at your costs and you're going to say, is what's on my inventory a true reflection? Because in accounting, we really want to make sure that we're representing properly what our company is worth. So we have cost versus net realizable value. And at the end of the year, if it's quite a bit different, then we will reduce or increase, but mostly reduce our inventory from its cost to the net realizable value. In other words, if I have on my books that my inventory that I purchased that was at the cost that I paid for it was $1 million, and today, because of whatever's going on in the economy, in the market, and so on and so forth, my inventory is only worth $200,000, it's not really proper for me to retain on my books the fact that I have assets worth $1 million. That just is not a proper representation of my assets. So I may need to mark those down. Okay, and so this just shows you that if I have a cost of $4,500 and my net realizable value, in other words, what's today's value of that stuff in my inventory? If it's only worth $3,000, I have to make an end of the year adjustment. Now, if the cost was $8,000 and the net realizable value is $9,000, I just use the lower of the two costs because I'm conservative, I'm an accountant, and we don't do things up, we only do things down when it comes to the cost and net realizable value. That's what we call it, the lower of cost or market. So which one is lower, the cost of what I paid for it or what the market says? And if the market is lower, I'll mark that down. and that's my adjustment. So I use it, I put it on as an expense, and I reduce the amount of my inventory. I actually didn't move physically any inventory, I just marked it down to be reflective. So at the end here, I actually put in a couple of questions for you. It says at the end of the year, company reports the following inventory values. So here's item A. There's 100 units at $4. The net realizable value is $8. So which one's lower, the cost or the net realizable value? Well, in this case, it's the cost, so I don't do anything. But on item B, if it cost me $8 and now it's only worth $6, I'm going to mark that. Sorry, I had to sneeze. I'm going to mark that down, right? So that's a $2 difference. I had $150, or excuse me, 150 units. So then the question asks me the amount to report for the ending inventory using lower of cost or market is going to be $1,300. There's my circle, because I take the $100 times the cost, which would be $400, plus the $150 times the 6, which is $900, totaling $1,300. And there's your explanation. And I gave you another question you can go over yourself. And then I put in a ratio at the end, and this is the inventory turnover ratio. What this tells us is how many times the company is turning over inventory. Now think about it. If you're a company, you're in the business of selling things, you want to be able to turn over your inventory. So that's what this ratio identifies, is how quickly you're able to turn over your inventory. Now, obviously, a company like Vons will be turning over inventory faster than a company like Tiffany. So you wouldn't be able to compare those two, but you'll want to really pay attention to the inventory turnover and relate that to a company that would be similar in a similar industry. So that's how we measure, that's one of the measures that we have for a company. And the other one is how many days things actually stay in the inventory. So you would take the 365 divided by the inventory turnover ratio to find out how many times or how many days that inventory is in your warehouse. Okay. Alrighty, and then there's a gross profit ratio. So I just invite you to kind of look at those. Okay, and that should be the end of chapter 5.